This is Bloomberg Intelligence.
We're really getting into now the streaming's arms race.
Dish is looking at that and saying we can really build a nice niche for ourselves.
In-depth research and data on 2,000 companies and 130 industries.
The dollar is the dominant concept in the planet.
I think the acquisition is a natural progression of what Microsoft can do with this technology going forward.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Over the next hour, we're going to dig inside the big business stories impacting Wall Street and the global markets. Each and every week, we provide in-depth research and data on some of the 2,000 companies in 130 industries our analysts cover worldwide. Today, we look at the global housing market as it heads toward what could be a painful correction. Plus, we discuss S&P 500 and how its capitulation signals are hinting at a bottom. But first, the U.S. state pension plans have helped climate-focused private equity funds navigate a tough summer. And with thinner deal volume and more available cash, private climate investments are on a long growth runway. For more, let's bring in Bloomberg Intelligence Head of Alternatives, Gaurav Patankar. Gaurav, thanks so much for joining us here. Talk to us about climate-focused investing and maybe the role that maybe some private equity players are playing in there.
Yeah, now there's a lot of exciting stuff happening. As you know, private equity was a theme du jour for asset owners over the last several years. And it's a long duration asset. With everything happening in the public markets, it's been a very, very tough road for private equity players or private equity managers to raise capital. However, our analysis shows that there is the small pocket of private equity managers that are focused on climate-focused investing that have been relatively successful and in many ways mostly unscathed when it comes to capital raising. And the climate-focused investments, mainly real assets focused on climate, are a sweet spot for asset managers.
So if I'm a private equity fund, I'm going right to the endowments because they have green initiatives. They're all behind it. I would think that would be easy pickings. Are the big endowments across the country, whether it's the Duke University Endowment or somewhere else?
Absolutely. The endowments and foundations have been longtime boosters of this type of investing. But what is very interesting right now is the biggest hand that's feeding capital into the private equity climate-focused investing funds is state pensions. So Oregon State Pension, for example.
They're always out front. They're one of the states that, because I know some people used to work there, and they just seem to always, I'm like, Oregon, where did that come from?
Now, some of these pension funds have been progressive, and our home state, New York State Common, they have not been too far behind either. So they are really getting behind some of these climate-focused initiatives as well. And we also have the Texas retirement system that is getting behind it. So there's a lot of state pension power that's powering a lot of private equity focused on climate.
What are some of the areas that the private equity folks are putting their money to work in climate? I mean, it's got to be, 2022 has been a real tough environment for everybody. I'm sure it's the same for getting deals done. But what are some of the areas that we've seen these private equity guys look?
That's a great question. And it's a tough environment when the deal volume, both in terms of volume and value, is shrinking. But in a way, it's not all that bad because if the deal volume is shrinking, the funds or the people that have capital and that are ready to deploy capital potentially can get some great bargains. So the areas that we see where there is the most amount of traction is in infrastructure. So real assets focused on climate change are getting a lot of traction. So think of subways, think of buses, think of green buses, think of green trains and things of that nature. And Brookfield Asset Management has been at the forefront of this, raising about $1.2 billion this year alone.
When you go look at somebody like a Brookfield Infrastructure, what's their pitch to people? We're going to build wind farms, solar farms, all that kind of stuff?
That's a very interesting question. If you just track the news flow over the last couple of years, they're quite global. There's some interesting deal opportunities all across the world. And I was just reading a news that crossed the wire a couple weeks ago was in terms of how Brookfield is going to India and building out climate-focused transportation infrastructure there and allocating capital there. So they've been sourcing deals at various places. They've been focused quite a bit on transportation, but that's not alone. They're into power, they're into wind, and various kinds of deals that are coming their way. So it's a catch-all kind of fund, but very focused on infrastructure.
When you think about climate investing, it is a global play. A solar farm works in India just like it works in California, just like it works, somewhere else. So are these private equity firms, are they going at it on a global scale, or are they kind of staying into their home markets?
They're definitely global. There's no doubt about it. But as the world becomes a little bit more geopolitically stratified, India is an excellent example. It's geopolitically quite well aligned with the West. So capital flowing in the form of Oregon feeding into Brookfield and Brookfield making investments in India kind of is relatively smooth. But would the same hold true for China or some other regions? Maybe not. And that is where we're going to see some change with some of these private equity managers reallocating their capital resources.
All right. Since we got you here and we're talking private equity, I got to talk about mark to market. When are we going to see some really ugly headlines coming out of these private equity funds that have had nothing but success raising capital, allocating capital, and putting up these eye-popping returns?
It's been a one-way train. It almost has been pitched by some consultants to asset owners, and we often joke about it as a great way to mark your book up without really the volatility that comes with public markets. But there are no free lunches, as we all know. And I think that moment might be around us, and that doesn't mean all of private equity is going to have severe headwinds. I mean, there's some great investments that have been made. It's all about the vintages. I think the vintages from 2019 to 2021 could be the ones that could have some significant challenges. And as the market downturn in the public market prolongs, there's going to be tremendous pressure from investment committees, from auditors. Some of these marks are now going to come back and sit on the books of the managers and ultimately flow back to asset owners. Now, that is where some of the asset owners are going to get tested with the commitment to private equity and private markets is truly long-term, or are they going to trim some exposures? I do believe that given the overall allocation, alternatives are still going to be a very important part of a university or a pension portfolio.
Absolutely. All right, our thanks to Bloomberg Intelligence Head of Alternatives, Gaurav Patankar. Coming up on the program, we'll explore the new highs and lows hitting extremes in the S&P 500. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney. It's 13 minutes past the hour, and this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Well, a short-term sentiment washout may be occurring with the recent stock rout, and now S&P 500 breadth and momentum signals hint that a new low is just around the corner. For more on this, let's bring in Bloomberg Intelligence Chief Equity Strategist Gina Martin Adams. We've been getting this question, I'm sure you more than anybody. Where is the bottom in this market? It's been 6 or 7 weeks of just nonstop selling.
Yeah.
How do you think about it? Trying to identify where a bottom may be?
Yeah. So generally, there are a few pretty reliable indicators of at least short-term bottoms in stocks, and many of those started flashing over the last few days, very similar to the bottom that formed in the middle of June, though this one has an even bigger sentiment washout. So things we look for are things like the percentage of stocks trading above their 50-day moving average usually falls below 5% at major lows. We've gotten there and then some over the last few days. You usually find momentum represented by a 14-day RSI falls below 30. We've gotten there as well. Correlations between stocks tend to spike in an extraordinary way at major turning points. And we've finally gotten to the point where the pairwise correlation in the large cap index has traded more than a standard deviation above long-term average. So all of these things on a technical basis would suggest that we're getting pretty close to low. I think the trouble that the market has and is probably going to continue to have for at least the near term is the fact that the other factor that usually creates a low is completely missing, and that is a pivot in Fed policy. Okay. And instead, the Fed is so very committed to maintaining this very, very hawkish stance to combat inflation and get inflation expectations under control. It doesn't look like we're going to get that Fed pivot anytime soon. And so the market is really left wanting for that traditional source of optimism where the Fed's got its back. Instead, the technicals are all flashing and saying that sentiment is horrific, but we are missing that critical cog.
One of the things that I've heard from a lot of folks is the VIX. I mean, the VIX is a little bit above 30. Yeah. A lot of folks say it really needs to get around and stay around 40 to really say, all right, people are just kind of feel like it's washing itself out.
Yeah, you finally got to that capitulation point, so to speak, in VIX. I've heard the same, and you do tend to find that the VIX usually spikes closer to 40 at major lows in the equity market. The problem we have in this particular scenario is the VIX never corrected to excesses, right? This cycle is so different in so many ways. And one of the ways is usually at your peak in stocks, the VIX is very complacent, well below long-term average. We never got far below long-term average like we typically do. So there was not a lot for the VIX to move on to start with. The one indicator that we've noticed is the VIX on a monthly average basis is actually maintained well above long-term average for 10 straight months now.
Right.
That's usually indicative of really strong recession drawdowns in the index. The only times we've seen that in the past are very big corrections in the S&P 500 affiliated with risk-off periods akin to, say, 2009 or 2001.
This sell-off has had breadth, as they say, over 50% of stocks down at least 20% from their highs. That feels like the pain's being shared by a lot of the stocks.
It has, and it's another trigger that we watch is you usually need to see more than 50% of stocks draw down at least 20% to suggest that it is a widespread washout. But most major corrections get to right around the 50 to 60% level. Usually those corrections average about 20%. And, clearly this has been a very, very quick, very vicious drawdown in the S&P. But nonetheless, it's another indication of a sentiment washout.
All right, so a lot of technical indicators are flashing what may be the beginning of a bottom. On the fundamental side, I'm concerned we still have earnings risk in this market. What's your view there?
Well, you're not alone. A lot of people are very concerned about the earnings risk. I think there is still a touch of downside to consensus estimates, but like everything else, this cycle will probably prove us all wrong.
Yep.
It has been truly bizarre, and the inflation component of this cycle very unique relative to our past experiences. When we look at all recessions, your average drawdown in earnings in a recession experience on the S&P 500 is 17%. But the range can be anywhere from a minor 4% drawdown in EPS to much more severe, something like a 2009 drawdown, which was greater than 2/3 lost of index earnings per share. So the variation in recession is very, very different. So it's really difficult to use past experience to model what to expect. When we try to model what to expect, we use the current run rate of economic indicators and say, okay, it could get a lot worse from here. It could get minorly worse from here. What's the most likely scenario? And we basically say, okay, we think that the current economic slowdown will likely get a touch worse. We will likely see some capitulation in financial markets ultimately work its way into some economic weakness, some greater economic weakness. The result of that model is we have maybe a 4% outlook for EPS growth. Mm-hmm. The consensus currently thinks the next 12 months the index is going to earn 8%.
Okay.
So that gives us a downside to 4. Our worst case scenario is you get a recession and you get a drawdown of closer to 20% in EPS. I think that's still very unlikely considering the inflationary landscape, but certainly it does at least give you a bogey for what's your worst case.
Right. So you have done a great job to consistently call out in your research and conversations with us and on Bloomberg Television margins. Watch margins. Certainly with this inflation, we've seen margin pressure across the board. Now I worry about interest rates. Are we going to hear companies saying, I missed my EPS because my interest expense came in higher than I was forecasting?
Yeah. I think it's a little early, but you're right to worry about that going into 2023 and 2024 in particular. If rates stay much, much higher into 2024, we will definitely start to hear that risk bubble up. For now, most companies fund themselves via longer maturity debt. Very few companies really rely on the commercial paper markets or short-term debt markets for funding. To the degree that they do, you might start to hear that. Our funding costs are going to go higher. But for the most part, S&P 500 companies generally fund long-dated. So you'll have to wait until we get to a point where a lot of that debt matures and then has to be refinanced. And at that point, it could become pretty problematic.
Has it been higher than usual, and that kind of confirms a process of, kind of capitulation a little bit?
Volume is so tricky, Paul. It's one of those indicators that volume for the broad S&P 500 actually peaked all the way back in 2001.
Oh, okay. All right.
So what we've found over the last 20 years is volume does spike on sell-offs and does tend to ease on rallies. And so we have seen volume pick up as the market has sold off, but it's still so light with the amount of public equities outstanding kind of just shrinking over time. It's really difficult for us to use volume as a measure these days.
Boy, that was my tried and true. When I see prices trading down on heavy volume, I said, that's about most of my technical analysis. All right, our thanks to Bloomberg Intelligence Chief Equity Strategist Gina Martin Adams. Coming up on the program, is the global housing market headed for a crash, or is it just a slowdown? You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney. It's 25 minutes past the hour, and this is Bloomberg.
You're listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
We'll be here each and every week at this time, tapping into our Bloomberg Intelligence analysts covering some 2,000 companies and 130 industries worldwide. The global housing market's momentum is coming to an end as surging rates, inflation, and energy prices join a list of would-be homeowners' concerns. Is it just a slowdown or a total crash? To answer that question, we're pleased to welcome Bloomberg Intelligence equity research analyst Iwona Hovenko. So, Iwona, you guys at Bloomberg Intelligence, you got a bunch of your housing analysts together, a bunch of the global economists, and you guys came up with a huge report on the housing market. What say you? Is this going to be a crash or maybe just a slowdown?
Well, the short answer is it depends where you are. So we've identified a number of countries that are more at risk of a crash, and these are probably unsurprisingly for some of people following the housing market, the countries that have actually seen the highest rises in the last few years. So that would have been Canada, Sweden, New Zealand and Australia. We think there is a bit more resilience in the U.S., so this was not our base case for the crash. Until about a week ago, I also thought the same for the UK market, but I think the latest mini-budget has been a bit of a game changer, unfortunately, probably for the worse.
First of all, how do you guys define a crash? Is it, a fall of 20% or more from the peak, or how do you guys define that?
We haven't defined it as such, but we felt like a low single-digit percentage move in either direction would have not constitute a crash. I would say if we go into double digits, that perhaps already constitutes a crash. However, in a lot of the markets, even if that double-digit price correction happened, prices would just return maybe to 2022, 2021, 2020 levels. So it's not exactly a disaster for existing homeowners. It's more for people who actually bought at a higher valuation.
Yeah, I learned just recently that the U.S. market you can get a 30-year fixed mortgage. We all know that. But in the U.K., for example, you don't get that. And so therefore, you have much shorter duration mortgages. And so therefore, you have much greater, interest rate risk here. So that would put the U.K. market maybe a little bit of a disadvantage.
Yes, absolutely. And you are right. However, we are still at a bit of an advantage compared to the likes of Australia, where basically majority, or Sweden, where majority of people actually are on a variable rate mortgages, so they immediately see the adjustment. In the UK, in terms of existing mortgages, around 20% of mortgages are on a variable rate, with another 20% going over their fixes for in the next year or two. So there is risk there. However, I would just like to outline that on average, a lot of the homeowners, based on the average price rises, over the past 2 years, they would have seen 20% price growth. The LTVs won't be that stretched, even if you accounted for a double-digit price correction in certain markets. And again, as with the countries, the same is the case with UK regions. The ones that have seen the highest price rises potentially are more vulnerable.
Talk to us about, kind of the loan-to-value ratio. How risky are kind of a lot of these loans? Because I think that kind of certainly comes into the question of whether the relative health of a housing market. Back before the financial crisis, a lot of loans here in the United States were really, really poor quality. And boy, that came home to roost. So from market to market, are you concerned about, the loan-to-value ratio?
Well, we aren't. That's the short answer. And similarly, as is the case in the U.S., UK lenders and regulators have learned very tough lessons. So in terms of the lending criteria, it's way, way tighter. And whereas before the global financial crisis, you've seen overall around 15% of all mortgages being on LTVs higher than 90%. And of the total, 5% were on LTVs above 95%. Right now, in the run-up to the recent crisis, let's call it a crisis because it is an energy crisis. Right now, it's above 90%. LTVs constitute around less than 5% of all lending, and more than 95% lending is not more than 0.5%, 0.5%. It's really a dramatic difference. And on top of that, you would have had much tighter. Lending criteria.
How about in China? I know we've been hearing more and more about the weak real estate market in China. Boy, they've got a lot of issues there with their zero COVID lockdown. Talk to us about the Chinese market.
The Chinese market is not a market I cover, but as a lot of the listeners will be aware, it's quite a different market than any other. So its troubles actually started last year when the government tried to regulate the developers, and now the situation has been such that due to the lack of liquidity, some of the homes have not been finished, and there have been simply unprecedented mortgage boycott. So buyers simply stopped paying the mortgages, which in turn is putting the developers under pressure to actually finish the homes that they promised they would deliver, because people literally have to pay mortgages on those things.
Yep.
And rates are actually being cut, but this is a wholly different dynamic than anywhere else in the world.
All right, good stuff. We really appreciate it. Our thanks to Bloomberg Intelligence equity research analyst Iwona Hovenko. Coming up on the program, we'll head to the UK, where sterling dollar parity believers may have a go after all. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney. It's 39 minutes past the hour, and this is Bloomberg.
You're listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Any way you slice it, this was a historic week for the FX market and for the bond market, particularly over in the UK. I mean, you had the pound hitting a record low. There's been calls for parity. Let's get a deeper insight here with Audrey Childe-Freeman, Bloomberg Intelligence Chief G10 FX Strategist. Can you just talk me through what happened from where you sit, the monumental moves that we've seen?
Absolutely. I mean, the scale of the move we've seen in the G10 currencies, and in particular on sterling, makes you think about the kind of move you usually see in the EM space. You know, this has been a narrative that's kind of become more and more popular, but certainly the price action confirms that. So going back to sterling, what happened is that we had a shift in sterling bearish driver from a broad, strong dollar story, cyclically driven and yield differential driven, to what I called a structurally driven sterling bearish case. So what I'm saying here is that the market is now shifting its focus on the dual current account and fiscal deficit situation that we have in the UK. And the trigger there was the mini budget that was announced last week in the UK. So the bottom line on that front is that we have massive fiscal stimulus being announced in the UK with a strong focus on tax cuts, which, by the way, in normal circumstances would have been quite good. But the problem here is that there's no spending cut measures to offset those ones, the tax cuts. And basically the market is questioning the UK medium-term debt sustainability. And that's not good at all, especially when you have a current account deficit and stagflationary forces that we already had to deal with in the UK. So we're now in a situation which I've kind of described a fiscal credibility crisis for sterling. That's where we are.
So, Audrey, typically having your central bank raising rates is good for your currency. Is there just too much other stuff going on with the UK that is not likely to be the case here?
Well, that's a very good point. And, it takes me back to the comparison with EMFX. When you think about, the price action that you see over time in some of the EM currencies, the sharp depreciation in the currencies, the central bank raises rates to try and address that problem. At best, it kind of contains any more downside in the currency. And sometimes at worst, it just delays the further weakness in the currency, but it doesn't solve the problem. And because the current situation in the UK, or the latest sell-off in sterling, that's what I should say, has been driven by this fiscal situation, I don't think the answer is of a monetary nature. So I kind of feel the Bank of England trying to address the problem in the gilt market makes sense, but it won't solve the sterling problem.
Does the BOE think that there is a sterling problem?
You can't deny the fact that the weakness in the sterling is exacerbating the problem for the UK economy. And first of all, it's exacerbating the inflationary problem. So this becomes a Bank of England problem. But if you raise rates very aggressively, and at the moment there's substantial rate increase priced in the UK markets, you then risk to really put your economy into deep recession. And certainly in the UK, the housing sector is highly dependent on rates. So there's a whole lot of a massive conundrum for the Bank of England. The situation is very difficult. And I'm not sure, I'd like to believe that, raising rates aggressively would be enough to potentially, trigger a reversal in sterling. But I don't really believe it will. I think this issue right now, in the near term, the main issue is the one about fiscal credibility. So it's the government that needs to come out and reassure the market when it comes to the medium to long-term direction for UK fiscal prospects. That's what needs to be done.
There was also conversation about a Plaza Accord sort of 2.0. I feel like this always comes up when the dollar is so strong. Janet Yellen talked about the fact that markets are still operating properly. Brian Deese dismissed the Plaza Accord scenario. And I'm just wondering, under what conditions does that take a more meaningful shift?
Well, I think we're not there just yet, but I also feel the market will talk about it more and more as the stronger dollar continues. At the moment, though, the Fed is very clear in its position. The Fed keeps on telling us the same thing, that rates are going to stay high for longer than what we were initially expecting. And that's basically a strong dollar policy in terms of its impact on the global currency market. And right now, I just feel that, the global economy probably is more preoccupied by the global gas and energy crisis than it is by the currency market. But, it could change. It could change depending on the pace of the move. Certainly what we've seen this week, it's a bit of a wake-up call, I think, for some in the central banking community.
Audrey, thanks a lot. I really appreciate it. Audrey Childe-Freeman, Bloomberg Intelligence Chief G10 FX Strategist. Thank you very much.
All right, let's turn now to the UK housing market, where the Bank of England's worry list grows. A quadrupling of two-year fixed-rate mortgages, along with UK base rate expectations reaching 5.5%, have the potential to hasten a housing downturn. For more on this, we bring in Bloomberg Intelligence senior banks analyst Jonathan Tyce. So, Jonathan, what I learned, I think maybe just this week from Matt Miller, my co-host, is that unlike in the U.S., where a lot of people have 30-year mortgages, the mortgages in the U.K. are much shorter in duration, like 10 years and less. So that brings a lot of refinancing risk into the marketplace. With interest rates rising, that's an issue. Tell us about it.
So the way that it works over here, as a rule, historically, you would probably get a 2-year deal, so you get a nice discount. But after 2 years, you either switch the mortgage to what they call a standard variable rate, which is much higher, or you refinance onto another deal. The problem, of course, is, take my mortgage, I was on 1%. To refinance that next year is probably going to be closer to 6%. So The other problem is that because rates are going up, every time a bank puts a new deal out, it's inundated. So the big high street banks over the HSBCs have just been pulling the offers, and they're coming back to market with much higher rates again. It's a vicious circle.
So give us a sense of how big housing is to an average consumer, how much of their net worth, because I know in Canada it's really much higher than it is here in the U.S. So how important is the housing market?
Well, I think the British psyche is very much that you think about your housing equity, a bit like a continental European who rents would think about their savings. So when you bear in mind that similar to the US, consumer spending is about 65-70% of GDP, it's massively important to growth, because if you have a feeling that your house value, your net worth is going to fall, by definition, you're going to really pull back on spending. So I think it's a double whammy for the Bank of England, not least as well because while they're targeting inflation, which is rampant, the dollar has rallied massively thanks to the new Prime Minister's measures announced last week. So we've got the imported inflation issue. And now, because first-time buyers and the housing market has been strong, but it's important to kind of consumer growth, the Bank of England has to have one eye on that as well. And it doesn't want to raise rates so quickly that it basically kills the housing market.
So give us a sense of kind of how the housing market is over in England.
Well, post-COVID, sort of from, I guess, the middle of 2020 towards the end of 2020, house prices have risen 10, 15% a year.
Yep.
In certain areas. I think we're running about 8-9% year on year at the moment. So if you're a bank, you're sitting there thinking, well, actually, my stock of mortgages is 50% loan to value. New business lending, we're doing it about 70, 75% loan to value. But of course, the first-time buyer and the high loan to value end of the market gets harder and harder the higher house prices go. And that's a key rung on the ladder. So over here, we had a guarantee provided by the government a couple of years ago to make sure that the younger people with smaller deposits get on the market. And at the moment, a lot of the banks have been offering very good rates for this because it's government-backed and government-guaranteed. That guarantee expires at the end of the year. So one concern is it's good that the government has announced another stamp duty tax relief for first-time buyers. But if that guarantee isn't extended, the pricing for sort of new first-time buyers is going to go through the roof. And that is a key rung on the ladder. So that's something that we're watching.
It's really amazing how this surge in interest rates is just kind of catching everybody a little bit by surprise here. And is it across the country, Jonathan, or are there certain parts of the country where housing has just really run rampant?
Well, the rest of the country's played catch-up with London over the past couple of years because, let's say the average price is £300,000 in the UK. It's nearly $700,000 in London. So there has been a sort of a two-phase growth story. I guess going forward, London has played catch-up a little bit again recently, but clearly where we had a levelling up agenda in this country, because London and the South East is where the wealth is, if house prices begin to tumble, then you've got an issue because the generational and the wealth gap, the wealth divide, just gets worse again. And a little bit as we're seeing elsewhere in the world, it was something that the Conservative Party made central to its outlook and to its policy, and it's failing miserably.
Just real quickly, are there any particular banks at risk here, Jonathan?
Well, the banks are pretty well capitalised. It's more about whether or not the growth that we were expecting in net interest income and also profitability gets hit because they have to start setting aside more provisions. But the biggest mortgage lender is Lloyds, and they're very well capitalised. So I think the downside is fairly limited at the moment, and the share prices are already discounting a lot. Am I worried about solvency? Absolutely not. The big question is the kind of growth that we were hoping would drive share prices over the next couple of years and buoy earnings, does that get eaten away because the banks start pulling back capacity and the regulator steps in?
Right.
That's the big question.
All right, good stuff as always. Our thanks to Bloomberg Intelligence Senior Banks Analyst Jonathan Tyce. That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. And remember, you can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney. It's 57 minutes past the hour, and this is Bloomberg.